Hello Kanna, I hope that you all are fit and fine, and let me tell you that I am completely fine as well. In this video, this is the final video of the amendment series for May 24 and November 24 examinations, and this class is equally important for all the students, that is for the students who have done coaching for May 24 also, and the students who have done coaching for May 23 or November 23 also, because this portion which I am going to discuss in this video is not there in your institute study material. This is a separate material that has been released by the institute, and this is definitely applicable for May 24 examination. Okay, sir, first and foremost, where can we get this material? To get this material, Kanna, if at all you have downloaded my notes from my website or from my telegram channel, then this material is already there in that notes, so you need not download it once again and take a printout once again. However, if you are just watching this lecture, if you have not used my notes, or if you have downloaded my notes earlier, then this material will not be there. In such case, go to ICAI.org. From there you go to BOS knowledge portal. There you will find a tab called amendments and developments. After going to that tab, go to the CA Inter option and you will find 3 statutory updates. So for your law paper also there are certain statutory updates, for your income tax also, and majorly for GST also. Okay, so make sure to update yourself with the other 2 subjects as well, that is law as well as GST. In this video we will be completing income tax. And as usual, my request to you is to subscribe to this channel and share this video with your friends dear, because they should also not miss out on watching this statutory update. Very very important. I predict that at least 4 to 6 marks will be asked in the May 24 as well as November 24 examinations from this statutory update alone. It is that much important. Okay, so let us discuss. In the statutory update, we will be discussing certain updates relating to salary, PGBP, income from other sources, then TDS chapter, and also return filing chapter. So all these chapters are there. Let us start with the salary chapter. The salary chapter changes is relating to rent free accommodation. Important, very important, very very important, because rent free accommodation already is one of the favorite questions of the examiners when it comes to the salary chapter, and now since there is an amendment, it will become even more favorite to come in the examinations. So in this rent free accommodation, let me just go to my notes. Okay, and from my notes itself I will tell you what and all changes you have to make. So when it comes to rent free accommodation, what is this rent free accommodation? It means what? Employer is giving an accommodation to the employee, and the employer is not charging any rent on that accommodation, or that accommodation is given on a very nominal rent to the employee, right? Now when it comes to the government employee, how to find out the value of the perquisite? The value of the perquisite is nothing but license fee prescribed by the government, and you should obviously reduce any rent that is recovered from the employee. This is as usual, no change at all. Now where is the change, Kanna? The change comes when the employer is other than government employer and the employee is other than government employee. There we learnt 2 types of headings, that is if the property is employer's own property or other than employer's property. Firstly, let us discuss other than employer's property. In other than employer property, earlier we learnt that the limit was 15% of salary or rent paid by the employer, whichever is lower. Now this 15% has been changed to 10%. Okay, so 10% of salary or rent by the employer, whichever is lower. Now let's come to employer's property. In employer's property also, now there are changes in the limits. So earlier it was 7.5%, 10% and 15%. Now that is removed. Now what you have to study? 5%, 7.5% or 10%. And 5% is for a population up to 15 lakhs, 7.5% above 15 lakhs up to 40 lakhs, and 10% above 40 lakhs. So in your notes itself, you please make this change. What change you are going to make? Number 1, in case of other property, the limit is now 10% instead of 15%, and in case of employer's own property, in that 5% for population up to 15 lakhs, 7.5% more than 15 lakhs up to 40 lakhs, and 10% for more than 40 lakhs. Okay. So since these limits have changed, don't refer the questions which are there in your study material, because in your study material the questions are solved using different rates. Okay, so you are going to get confused. Either you yourself solve the question using the new percentages that is given, or you just ignore. You learn this thoroughly, and if it is coming in examination, you should know how to apply those rates. Okay, next let us come back to the statutory update. So in statutory update, that is only given karna. In case of government employee, there is no change. In case of non-government employee only, where the accommodation is owned by employer, then 10%, 7.5% and 5%. And when the accommodation is taken on lease or rent by the employer, that means other than employer's property, then 10% has become the limit. All the other provisions are same as it is relating to furniture, recovery of rent from the employee, everything is same. There are some other changes also, let us discuss. Okay, so now listen here. Accommodation provided on account of transfer from one place to another. This also we have already learnt. There is no change. Okay, so if at all there is transfer of the employee and the employer is providing two accommodations, then for the first 90 days you have to take the lower of both the accommodation as taxable perks, and after 90 days both the accommodation will be taken as taxable perks. Okay, so that update is same. Now this is a new point. Value of perquisite to be restricted to CII, that is cost inflation index. Okay, so what does the provision say? This is a very new type of provision where now capital gain is coming inside salary chapter. Okay, where the accommodation is owned or taken on lease or rent by the employer, and the same accommodation is continued to be provided to the same employee for more than one previous year, the value of perquisite as calculated in 2 above shall not exceed the amount so calculated for the first previous year as multiplied by the amount which is a ratio of CII of the previous year for which the value is calculated and the CII of the previous year in which the accommodation was initially provided. So what are they telling? That if an accommodation is provided for more than 1 year karna, the same accommodation, if it is provided for more than 1 year, then from the second year onwards you have to see whether the perquisite value is more than the cost inflated value. Okay, if the perquisite value is more than the cost inflated value, you have to restrict it to the perquisite value. Let us learn with the help of an example, you will be very clear. So this provision has started from previous year 23-24 only. Okay, so let's say in previous year 23-24, an accommodation is provided to the employee. Let's say after doing all the calculation, the perquisite is coming as 5 lakhs, and we know that cost inflation index of 23-24 is how much? 348. We learnt in the capital gain chapter. Now let's come to 24-25. Let us assume that the same accommodation is provided by the employer to the employee for the second year also. So in the second year, what to do? The second year, let us assume that after doing the calculation, normally you are getting the perquisite value as 7 lakh rupees. Okay, now you have to do one extra calculation. What is that? This perquisite has to be restricted to the cost inflated value of the previous year. So you have to find out 5 lakh divided by cost inflation index of 23-24 multiplied by cost inflation index of 24-25. But do we know the cost inflation index of 24-25? We do not know, because the government has not even announced it yet. So let us assume that the cost inflation index of 24-25 will be 370. In such case, the perquisite value is coming as 531609. Hence the maximum perquisite can only be how much? 531609. So this is a benefit which is given to the employees so that their perquisite should not go beyond a certain level. Okay. This provision, I don't think for May 24 and November 24 it will be tested. Max to max it can be tested in multiple choice question, because for testing this provision obviously you need to know the cost inflation index of future years. Okay, which is not possible. However, if at all the institute wants to give a question, it can ask you to assume the cost inflation index, or they will give some random cost inflation index and ask you to calculate. So coming back to salary chapter, one small note you make. See here, from previous year 24-25 onwards, that is from the next previous year onwards. For you, the previous year applicable is what? 23-24 for May 24 and November 24 exams. We are talking about previous year 24-25, that is for the next year. Maximum perquisite for non-government employees, if there is the same accommodation, then what is the maximum perquisite? It will be perquisite in the preceding previous year divided by cost inflation index of the preceding previous year multiplied by cost inflation index of the previous year. So wherever you find space, you please make a note of this one line. If at all it is asked in multiple choice question, you should be able to answer. Not that important, Kanna. Done? Okay, let's go back. Then here they have given about employee serving on deputation. See, employee serving on deputation is not an amended clause, it is an old clause only. Basically what they are trying to tell, if there is a government employee, okay, sometimes what will happen, the government employee will ask the government will ask the employee to go and serve in another organization, okay, and maybe that organization will not have a license fee prescribed, because it will not be a government organization, it might be private or it might be a public company also, okay. So in such case where you do not have the license fee for the government employee, then solve the question as if he is a non-government employee. That's all, nothing big. Fine. If you read this provision, you will be able to understand better. So after this video, you can read it once, brush up, not that important. You will be able to answer in the exam, no problem. Now, profit and gains, that is PGBP chapter. In PGBP chapter, one small update Kanna. What is that? Section 35D. This update also we have already discussed. In 35D, we had already learnt the amendment that for this 4 types of expenses, that is feasibility report, project report, market survey and engineering services. For these 4 type of expenses, now particulars have to be furnished in the prescribed manner within the prescribed time to the prescribed authority. So it means what? Income tax authority. So now time limit is given. What is the time limit? It is 1 month prior to the due date of furnishing return of income. This also I have already told you in the amendment lecture, and I have asked you to note down also. If you have not noted down, now you can note down. In section 35D, so for these 4 type of expenses, the time limit is what? 1 month before the due date to file the return of income. Now coming to income from other sources, Kanna. Income from other sources, now we are going to speak about 1010D. Detailed discussion, very thoroughly. I have already told you about the 1010D and we drew a huge big chart also. Okay, now nothing has changed. There is no new update or no new amendment. It is just that CBDT, our income tax department, has given many examples of solving the questions. And since the examples are already given, high chance that you might get a question from these examples itself in your examination where the numbers are slightly changed. Okay, so let us solve all the examinations. Very simple. If you know the concept, you will be able to solve it easily. First, let us visit the provision. Then one by one we will solve the examples quickly. Okay. Provisions we had discussed when we were discussing the deductions amendment. Okay. I think it is part 4 of this series only. So in life insurance policy, I told you that you have to see whether policy is issued before 1/4/2012 up to 31/3/13 or after on or after 1/4/2013. Before 1/4/2012, the limit was 20% of sum assured. Between 1/4/2012 to 31/3/13, it was only 10%. From 1/4/2013 onwards, the limit was 10%. However, for deceased people, it was increased to 15% of sum assured. So that we know. If the premium is more than the limit, then the maturity amount will not be exempt. Repeat once again. if the premium is more than the limit, then the maturity amount will not be exempt under 1010D, it will be fully taxable. Okay, so if the conditions are not satisfied, it is taxable. If it is a ULIP, it will be taxable under capital gain. If it is not a ULIP, then it will be taxable under IFOS, that is 56 to 13. Now let us see, sir, conditions are satisfied. If conditions are satisfied, then you have to see additional conditions. This additional condition only was the amendment which has come from May 24 and November 24 attempt onwards. What did we learn? This ULIP we are not discussing as of now because this statutory update does not include ULIP. Let us discuss all the policies other than ULIP. So if the policy is issued before, okay, here I think I asked you to make changes, correct? I will go to IFOS itself. Yeah, here changes have been made. Yeah, if the policy was issued before 1/4/2023, then no problem at all. Whatever earlier provisions are there, that only you should follow. However, if the policy is issued on or after 1/4/2023, then if the aggregate premium is within 5 lakh rupees, then it is exempt under 1010D. What is exempt? Maturity amount is exempt. But if the aggregate premium is more than 5 lakh rupees, then the assessee has the option to choose the policies whose premium is within 5 lakhs and the remaining policies will become taxable. Okay, so this was the provision, correct? Now let's come to statutory update. Let us solve the examples one by one. After solving, you will have even more clarity. Okay, so first example, date of issue is 1/4/2013. So this policy is before 1/4/2023. So that 5 lakh rule and all will not apply. Only the earlier rules will apply. That is 10%, 15%. The premium is how much karna? 6 lakhs. Sum assured is how much? 60 lakhs. Consideration received is how much? 70 lakhs. Now you should see whether the sum assured, whether the premium is within the limits. So what is the limit? Limit is 6 lakhs multiplied by 10% is equal to 60 lakhs multiplied by 10% is equal to 6 lakhs. Is the premium within 6 lakhs? Answer is yes. Hence, this maturity will be exempt. Fine. Under 1010D. Once again, I am repeating this. If you are not able to understand, then nothing else you will understand. This question does not contain any amendment. This is as usual old question. Okay. Premium is 6 lakhs. Premium should be within 10%. Correct? If it is within 10%, entire maturity is allowed. Since premium is within 10% of sum assured, entire maturity of 70 lakhs is fully exempt. Now coming to example 2. Paklama. Example number 2. Just a second. Yeah. Date of issue of policy is 1/4/2023. Since it is 1/4/2023, the new provisions will apply. The 5 lakh limit. Okay. Annual premium is how much? 5 lakh rupees. Sum assured is how much? 50 lakh. Is this premium within 10%? Answer is yes. Is this premium within 5 lakh? Answer is yes. So since both conditions are satisfied, the amount is fully exempt. The maturity amount is completely exempt. Now let's see example 3. Date of issue of policy is 1/4/2023. It means what? The 5 lakh limit will apply. Sum assured is 60 lakh. Premium is 6 lakhs. Is it within 10%? Answer is yes. But however, the premium, is it within 5 lakhs? Answer is no. It is not within 5 lakhs, and that is why this entire maturity value will be taxable. How to kandupudichify the tax? How to calculate the tax? Using 56 to 13. That also I have taught you how to calculate. First you have to take the maturity value including the bonus value. From that you have to reduce the premium that you have already paid. But from that premium also you have to reduce the deduction that you have already claimed. Okay. If you are confused, go back to the IFOS chapter and see. Let's come to next example. Here they are talking about two policies karna. Policy A irukku. Policy A is there and policy B is there. Just a second. Yeah. Policy A is there and policy B is there. Policy A date of issue is 1/4/2023, B also 1/4/2023. So both policies have been issued on or after 1/4/23. So for both of them, that 5 lakh limit or aggregate 5 lakh limit is going to apply. Now listen very carefully. If you have more than one policy, first you find out the answer for each and every policy individually. After that you see both of them together and then find out the combined answer. Okay. So firstly, let us see policy A. Premium is 3 lakhs, sum assured is 30 lakhs. Is it within the limit? Answer is yes, it is within limit. Is it within 5 lakhs? Answer is yes, it is within 5 lakhs. Now, let's see policy B. Policy B, premium is 2 lakhs, sum assured is 20 lakhs. Is it within the limit? Answer is yes, it is within 10% limit. Then, is the sum assured within, is the premium within 5 lakhs? Answer is yes, it is within 5 lakhs. So both are eligible for exemption. Okay. Now let us see aggregate. Is aggregate within 5 lakh? Answer is yes. Aggregate also is 5 lakh rupees. Since 5 lakhs is within the limit of 5 lakhs, that is why both the policies are exempt. You get my point? Next. Example number 5. Policy A, policy B. Both policies issued on or after 1/4/2023. Now let us see both of them individually. Policy A, 10% condition satisfied within 5 lakhs also. Hence, this 52 lakhs is eligible for exemption. Next, second policy is 5,50,000, which is more than 5 lakhs. So it is not eligible for exemption. So now it is very simple. This 52 lakhs, you claim it as exemption, that is the maturity amount, and for the second policy, maturity amount will be taxable under section 56(2)(13). Okay. Now, example number 6. 3 policies, policy A, policy B, policy C. So for 3 policies also same way. For each and every policy you see separately, then we will see all the policies together. All the 3 policies have been issued on or after 1/4/2023, right? Now for policy A, is it within the limit? Answer is yes. Is it within 5 lakhs? Answer is yes. Policy B, is it within 10% limit? Answer is yes. Is it within 5 lakhs? Answer is yes. Now let's see policy C. Is it within 10% limit? Answer is yes. But is it within 5 lakhs? Answer is no. So policy C is 100% taxable. So you leave it aside. However, you have to pay tax for the maturity amount. Now see the remaining policy. Remaining policy is A and B. Both of them combined, what is the premium? 4,50,000. Now is this 4,50,000 within 5 lakh limit? Answer is yes. So both of these policy maturity amount, that is 12 lakh and 40 lakh, you can claim it as exemption. Fine. Next, example number 7. So here there are 4 policies kana. X, A, B and C, and here be very careful. The policy X is issued before 1/4/2023 and A, B, C are issued on or after 1/4/2023. So this before 1/4/2023 you have to see separately kana. You should not take this account in aggregate. See this separately. ABC and ABC you have to see separately. For 1/4/2023 there is only that 10% limit. Is the 10% limit satisfied? Answer is yes. Hence the maturity amount is going to be fully exempt. Okay. Now let us see A, B and C. For A, B and C, for let's say policy A, is the condition satisfied? Answer is yes, 10% satisfied within 5 lakhs. Policy B, 10% condition satisfied within 5 lakhs. Policy C, 10% condition satisfied, however greater than 5 lakhs. So policy C is going to be taxable. Policy A and B both put together are coming as 4,50,000. 4,50,000. Hence, since it is within 5 lakhs, both of them are going to be exempt. Okay. If you are having confusion, look at this example once again, look at the provisions once again, then only you will have clarity. Okay, don't skip this till you get clarity. Let's come to example 8 karna. In example 8 also there are 4 policies, X, A, B and C, and here all the 4 policies have been issued on or after 1/4/2023. So you have to see all the 4 combined. Okay, combined aggregate should be within 5 lakh rupees, correct? Fine. Now for the first policy, is it within 10%? Yes. Is it within 5 lakhs? Yes. Second policy, within 10%? Yes. Within 5 lakhs? Yes. Third policy, within 10%? Yes. Within 5 lakhs? Yes. Fourth policy, within 10%? Yes. But within 5 lakhs? No. So the fourth policy maturity value is going to be taxable, correct? Now for the first 3 policies, what is the aggregate value? Aggregate value is coming as 4 lakh 50 plus 1 lakh 5 lakh 50 plus 150, it is coming as 7 lakhs. So here also, out of these 3 policies, you have to choose which policy you want to treat it as exempt, and balance policies you have to treat it as taxable. Only the policies whose premium is within 5 lakh rupees will be treated as exempt, balance policies will be treated as taxable. Okay, so here what you can do, you can either choose X, that is 4,50,000. You can either tell that I will choose X as exemption and A and B I will tax. Okay, or you can choose A and B, which will come to around 2,50,000, and you can choose X as taxable. So either you can choose X or you can choose A and B, and it depends on multiple factors karna. How much premium you have paid, how much deduction you have claimed on the premium, all those factors are dependent. However, in this question we are not getting all those factors, you are only getting the maturity value. That is why just solve the question based on the maturity value. Wherever you get highest benefit, that you have to choose. So maximum amount try to claim it as exemption, balance amount let's try to keep it as taxable. Now if you choose policy X as exempt, then for how much amount you have to pay the tax? You have to pay the tax for 12 lakhs plus 18 lakhs, which is how much? 30 lakh rupees you have to pay the tax. If you choose A and B as exempt, then for how much amount you have to pay the tax? You have to pay the tax for 50 lakh rupees. Now what will you choose? Would you like to pay tax for 50 lakhs or would you like to pay tax for 30 lakhs? Answer is you would like to pay tax for 30 lakhs and keep 50 lakhs as exempt. Hence, in this case, you have to choose that A and B should be taxable and X should be exempt. Okay. So A and B will be taxable and X will be exempt. The answer would be given. You please read, you will be able to understand. Okay. Now next example, similar case, X, A, B, C. Here also 4 policies are there karna. In the first policy, within limit within 5 lakhs, within limit within 5 lakhs, third one also within limit within 5 lakhs, fourth one is more than 5 lakhs. So fourth one maturity value automatically it is going to be what? It is going to be taxable. So this is taxable, we know. Now we have to see what is the aggregate amount of the remaining policy. Remaining policy aggregate is how much? 2,50,000 plus 2,50,000, that is 5 lakhs, plus 2 lakhs, that is 7 lakhs. So here also it is coming as 7 lakhs. So one of the policy you have to treat it as taxable and 2 policies you can take it as exempt. So see here. Now, sir, what if I choose X and A as exempt? If I choose X and A as exemption, then 30 plus 24, 54 lakh rupees exemption I will get. Correct? If I choose A and B as exempt, then 24 plus 38, 62 lakh rupees exemption I will get. If I choose X and B as exempt, then 30 plus 38, that is 68 lakh rupees exemption we will get. since the highest exemption is there in this combination, that is X plus B, that is why we will choose A as taxable. B will be exempt, X will be exempt. So 2,50,000 plus 2,50,000, that is 5 lakhs. So within 5 lakhs you will claim exemption, balance amount will be taxable. Okay. Now see Kanna, 10th example, there are 5 policies and all the policies are issued on or after 1/4/2023. For the first policy, is it within 10%? Answer is yes. Is it within 5 lakhs? Yes. Next also within 10%? Yes. Within 5 lakhs? Yes. Third one also within 10% within 5 lakhs. Fourth one also within 10% within 5 lakhs. Fifth one is within 10% but not within 5 lakhs. So this 70 lakhs maturity amount is definitely going to be taxable, right? Now what and all combinations you can make in this particular question? Let us see. You can make X plus Y, then you can make X plus A, right? Then you can make X plus B, correct? You can make X plus B. Can you make 3 combinations together? Answer is no. You cannot make 3 combinations together, because if you club 3 policies together, it is going more than 5 lakhs. So you can choose only 2 as exempt and 2 have to become taxable. So what is my suggestion is, see, this policy B is there, no Kanna, its maturity value is coming as 36 lakhs. So definitely you will want 36 lakhs to be exempt. So definitely B should be exempt. Now you should choose whether you want to choose policy A, policy X or policy Y to be exempt along with B. Fine. Policy A maturity value is coming as 24 lakhs. Policy Y also 24 lakhs and policy X is 12 lakhs. So you can either choose B plus A or you can choose B plus Y. Both are correct. Both will give you the same answer. And if you choose B plus A, then X plus Y will be taxable. If you choose B plus Y, then X plus A will be taxable. Okay. You read the answer, you will have even more clarity. So in this question, you will claim the exemption for B and A or B and Y. Both are okay. Okay, now one more final point, one clarification with relating to GST component. Look here Kanna, we have seen the limit, correct? The limit of premium should be 5 lakh rupees. This 5 lakh rupees, we should see it as including GST or excluding GST. Answer is we should not consider GST. So this 5 lakh you have to see excluding GST. So don't consider GST. Apart from GST, what is the value you see? That value only you should consider in the 5 lakh rupee limit. Fine. Okay. Now one more clarification, very important Kanna, very important, that in case of term life insurance policy. Sir, what is this term life insurance policy? This term life insurance policy means a policy on which there is no maturity amount. The amount of the policy will only be received on death of the person. If the person does not die, nothing will be received. If the person dies, then the family member or the nominee will be getting the maturity amount or the policy amount. Okay. So for such policy, you need not see the premium. Okay. Whether for that 5 lakh calculation, it is always exempt. The maturity value is always exempt. So you need not consider the premium in that 5 lakh calculation, even if the policy is issued on or after 1/4/2023. For what Kanna? For term life insurance policy. So this detailed discussion is over. I hope that you are clear with the section 1010D and 56 to 13. Here 56 to 13 calculation is also given. This we have already discussed Kanna. Still, this institute language, once again you can have a reading, you will have even more clarity. Now let's come to the TDS chapter. Okay, in TDS chapter there is one small update in section 194A, and that is for Mahila Samman Saving Certificate, TDS need not be deducted on the interest. So you come to your TDS chapter, come to section 194A, and in that you please make a note. No TDS is required to be deducted on Mahila Samman Saving Scheme. Mahila Samman Saving Scheme. You please make a note. Done. That's it. Nothing much. Next. Now let us discuss about the clarifications given about section 194BA. What is this section 194BA? TDS relating to online games. Online games. We have already discussed in the amendment lecture about this section. What did we discuss, Kanna? We had discussed, let us revisit this section in short once again quickly. 194BA. Yeah. First and foremost, who will be the deductor? The online gaming intermediary. Who will be the deductee? The user, that is the person who is playing the games and winning the prize. Then what is the limit to deduct the TDS? Answer is there is no limit at all to deduct the TDS. What is the rate of TDS? It is 30%. When should the TDS be deducted? It should be deducted on every withdrawal of the net winnings, and at the end of the financial year, whatever net winnings is there in the balance, on that also TDS has to be deducted. So this is the provision. Now let us discuss what is given in the guidelines. First guideline given by CBDT. There are a large number of gamers who play with very insignificant amount and withdraw also very small amount. Deducting tax at source under section 194BA for each insignificant withdrawal which would increase compliance for the tax deductor. Can there be any relaxation to ease compliance? So let us see what practically happens. Okay. And for that difficulty, CBDT has given a solution that is also very comedy solution only. Let us discuss. Let's take example of Dream 11 Kanna. Okay. So in this Dream 11, let's say I am the gamer. PB sir is gamer. Okay. Now let's say I have won 1000 rupees. In Dream 11, I have won 1000 rupees. From that, I want to withdraw 50 rupees. Then I will again withdraw 40 rupees. Then for my tea expenses, I am withdrawing money from Dream 11 and that I am using for drinking tea. Okay, tea, coffee, bhaji, bonda, everything. Then I am withdrawing some 70 rupees. Like that, I am withdrawing tiny amount. Now here what is happening? I already told you that there is no limit on this TDS section. So what will happen? 30% has to be deducted on 50 rupees. So 15 will be deducted, balance 35 only will come to my account. 15 rupees TDS has to be deposited to government. Then again on 40 rupees TDS has to be deducted. Then again on 70 rupees TDS has to be deducted. Correct? For each and every small kuti transaction, the company is forced to deduct a TDS. And this increases the compliance burden on the company because there are so many number of entries. Because the people in India, there are so many people in India who are definitely going to withdraw some small amount from this gaming apps. In such case, the government or the CBDT in a circular has given a relief. What is the relief? Let us see. The relief is that no TDS need to be deducted. So TDS need not be deducted if the withdrawal does not exceed 100 rupees in a month. Okay, does not exceed 100 rupees in a month. However, there are conditions, Kanna. What are the conditions? Tax not deducted on account of this occasion is deducted at a time when the net winnings comprised in withdrawal exceeds 100 rupees in the same month or subsequent month, or if there is no such withdrawal at the end of the financial year. So what they are telling now, since it is 50 rupees, no, this is 50 rupees, so no need to deduct the TDS. So when should they deduct the TDS? When the withdrawal becomes 100 rupees, they can deduct the TDS. So here 50 rupees is there, 40 rupees is there. Total how much? 90 rupees. So no need to deduct the TDS. Now when I am withdrawing 70 rupees, they have to deduct the TDS on the entire amount. That is how much? 50 plus 40 plus 70, that is 160 multiplied by 30%. TDS should be deducted and balance only should be paid. Correct? Fine. Now let's come to the third condition. Third condition is that the deductor undertakes the responsibility of paying the difference if the balance in the user account at the time of tax deduction is not sufficient to discharge the tax deduction liability. So what they are telling? See, listen here. Let's say I have totally 100 rupees in my account. Okay, let us take example of 110 rupees. That will be better. Okay, wow. First I will withdraw 50 rupees, no TDS. Then I will withdraw 40 rupees. On that also no need to deduct TDS because total amount is within 100 rupees. Correct? Then third time I will withdraw balance 20 rupees. Now listen here. For this, so total is how much? 110. Correct? For 110, how much is the TDS? 30%. It will come to 33 rupees. Now total withdrawal itself 20 rupees karna. How to deduct 33 rupees from this? It is impossible. Correct? So now what is the CBDT telling? CBDT is telling you deduct the entire amount 20 rupees and you pay to the government, and 13 rupees is there, no, you pay from your own pocket. That the CBDT is asking Dream 11 to pay this 13 rupees. You're sambarjifying so much, no, earning so much, no, so pay this 13 rupees from your own pocket to the government. So will Dream 11 implement such type of relief? Answer is definitely not. So this is just a dummy relief that is given to gaming companies. I doubt if some companies are going to even apply this practically on their withdrawals. So in short, this is not that important, but still, since it is now given in your statutory update, I am just teaching you that there is a relief given by CBDT. What relief? If the withdrawal is less than 100 rupees, no need to deduct the TDS. But in the next withdrawal, if it is crossing 100, then on the entire amount TDS has to be deducted. But if the amount is not sufficient to deduct the TDS, then pay from your own pocket. Okay. Next, when the net winnings is in kind, how will the tax deduction operate? This I have already discussed, Karna, while taking the section. I told you under section 194BA, the winnings can be in cash also and it can be in kind also. If the winnings is in kind and cash is not sufficient to pay the TDS, then the person who is giving the winnings, that is the online gaming intermediary, should make sure that the person who is receiving the winnings should first pay the tax. Then on showing the proof only, the person should give the winnings. Okay. So for example, if a person is winning a car, okay, the car value is 10 lakh rupees. And the person who is receiving the winnings is Mr. A, and gaming company is giving this car to Mr. A. Then what should Mr. A do? First Mr. A should pay the tax. Then this tax challan should be showed as proof to the gaming company. Then only the gaming company will give this car to Mr. A. You get my point? So that only is given. You please read by yourself. Next. How will the valuation of winnings in kind be carried out? Okay, Kanna. So now, whenever the winnings are there in the kind form, then how to find out the value of the winnings? Okay. So this car example I took, no. How to know that the value of this car is 10 lakh rupees? Let us find out. First and foremost, if the gaming intermediary has themselves purchased the winnings, then take the value as purchase price. So if the gaming company has only purchased the car, then the purchase price of the car will be taken as value. Okay. However, if they have not purchased, they themselves have produced or manufactured that product or winnings, in such case, what money they charge from their customers will be taken as value. Okay. So if this company is a car company and they are only producing cars, in such case what will happen? Then for what price they sell the car to the customers will become the value of the winnings. Okay. Next. So this section is over. Now we are coming to TCS 206C. Okay. This amendment also we have already discussed in TCS. Let me go back to that amendment. Very, very important, Kanna. Listen carefully. High chances that something from this clarification can come in your examination. 206C 1G I have already taken. There is no new amendment and all, but there are a few clarifications. Let us paste this there so that we can refer whenever we want. Now listen here, Kanna. What is given in section 206C 1G? That in case of remittance under the liberalized remittance scheme, or in case of payment made to overseas tour program package, in both the cases TCS has to be collected under this section, that is 206C 1H. We had learnt the percentage also. There are many cases. Now for in case of LRS authorized through a authorized dealer, in case of an education loan up to 7 lakh rupees, no need to collect TCS. Above 7 lakh rupees, 0.5%. Then in case of education expense other than education loan, and in case of medical treatment up to 7 lakh rupees, no TCS. Above 7 lakh rupees, 5%. Then in case of all the other types of remittances up to 7 lakh rupees, no need to collect TCS. Above 7 lakh rupees, up to 30th September, 5% was the rate. After 30th September, the rate was increased to 20%. This we studied. Correct? Now let us learn about overseas tour program package. Up to 7 lakh rupees, 5%. There is no limit and all. Starting itself there is TCS. So even if it is 10 rupees or 100 rupees, TCS has to be collected at 5%. Above 7 lakh rupees, up to 30th September, the rate was same only, 5%. And from 1/10/2023 onwards, it was increased to 20%. So this is the provision. Now based on this provision only, many guidelines are given, very interesting guidelines. So let us see those guidelines one by one. Number 1. Whether payment through overseas credit card would be counted in LRS. This I think I have already told you in the video, that overseas credit card or international credit card will not be counted in LRS. So no need to collect the TCS. Okay. Now let's come to second question. Whether the threshold of 7 lakh rupee for TCS to become applicable on LRS applies separately for various purposes like education, health treatment and others. For example, if remittance of 7 lakhs under LRS is made in a financial year for education purpose, other remittances in the same financial year, 7 lakhs is made for medical treatment and 7 lakh is made for other purpose, whether the exemption of 7 lakhs shall be given to each of the three separately. Very, very important, Kanna. This 7 lakh limit is there, no? This is a separate limit, or is it a combined limit? Answer is it is a combined limit. Okay, wow, it is a combined limit. So draw a danger symbol over here. Listen here very, very carefully. So see this. Now we are only talking about authorized dealer, Kanna. We are not talking about overseas tour program package. This is totally separate. Overseas tour program package is totally separate. We are only talking about authorized dealer. See, here also 7 lakh limit, here also 7 lakh limit, and here also 7 lakh limit. Is this 7 lakh limit three different limits or same limit? Answer is it is same limit. All the three combined only you have to see 7 lakhs. After 7 lakhs, whatever payment you make, it will be taxable either at 0.5% or 5% or 5% in the other case or 20% in the other case. Okay. So in this question what they have told, that 7 lakh expense is made for 7 lakh expense is made for education, 7 lakhs for medical and 7 lakh for other purpose. So first 7 lakhs will be exempt karna. After the first 7 lakhs, depending on what nature of payment you have made, that amount will be taxable under that rate. So see here, first 7 lakhs, no TCS. Okay. Beyond 7 lakhs, if it is education purpose, then it is 5% or 0.5%. If it's an education loan, then 0.5%. Other than education loan, 5%. Medical, if it is medical, then 5%. Okay. And if it is other purpose, then it will be up to 30th September 5%. After 30th September, that is from 1st October onwards, it will be 20%. Okay. Since there are, now next question let us see. Since there are different TCS rates on LRS for the first 6 months and next 6 months, whether the threshold of 7 lakhs to be seen separately for each 6 months. So this question also might arise, that for till 30th September, okay, in the others case, the rate is only 5% above 7 lakhs, and after 30th September it becomes 20%, correct? So this is this limit different till September, and after October will the limit start once again? From October onwards will the limit start once again? Answer is no. There is only one limit karna for the entire year. Okay. So let's just take an example. Let's say a remittance under LRS was made on 1/5/2023 of 5 lakh rupees. Okay. Then one more remittance was made on 30th August 2023, another 5 lakh rupees. Then one more remittance was made on 30th November 2023, another 5 lakh rupees. So what will be the TCS? So and let us assume that it is other purpose. Other purpose means what? Other than education or medical treatment. Okay, wow. So first 5 lakhs exempt. No need to deduct the TCS. No need to collect the TCS. In the next 5 lakhs, on the first 2 lakhs, no TCS. Next 3 lakhs, TCS at 5%. Correct? So that on the first 7 lakh, there should be no TCS. Only above 7 lakhs, TCS will come. Then on the last 5 lakhs, since it is on or after 1st of October, TCS at 20%. You get my point? Are you clear? Okay. Let us proceed to the next question. Whether the threshold of 7 lakh for TCS to become applicable on LRS applies separately for each remittance through different authorized dealers. If not, how will authorized dealer know about the earlier remittances by that remitter through some other authorized dealer? Now listen very, very carefully. Last year till November 23 you have learned this in a different way. Now it is clarified in a different way. So listen very carefully. Sir, there are two authorized dealers. Authorized dealer. Okay, first authorized dealer is SBI. Second authorized dealer is IDFC. Okay. Let's say the customer is Mr. A. Now from SBI, Mr. A took 6 lakh rupees of foreign currency under LRS scheme, and from IDFC also Mr. A took 6 lakh rupees of foreign currency. So now, do SBI and IDFC have the same database? Answer is no. So is the limit separate? The 7 lakh limit, is it separate for each authorized dealer? Answer is no. The limit is same. The limit applies to the customer, that is Mr. A. This you are learning only like this now. Earlier we have learnt in a different way, so listen very, very carefully. So the limit of 7 lakhs applies per customer. It does not apply per authorized dealer. Okay. The CBDT is telling that they are developing a technology where they will have a common database in which they will record all the remittances, and they will share this database with all the authorized dealers. However, this database is not yet ready. The technology is not yet ready. So if it is not yet ready, how will SBI know how much remittance is made through IDFC? How will IDFC know about SBI database? Answer is very simple. The customer only has to tell. So Mr. A will first withdraw 6 lakh rupees from SBI. It is Mr. A's responsibility to tell IDFC that I have already done foreign remittance of 6 lakh rupees through SBI, and after that now I am coming to you and doing balance amount. Okay, so after this information is given to IDFC, what will IDFC do? On the first 1 lakh rupees, no TCS. On the balance amount, TCS will be applicable at whatever rate is there. Okay, you get my point? Sir, now comes the doubt. What if Mr. A, who is the remitter, he does not disclose to IDFC that he has already done remittances through SBI? If Mr. A will not disclose to IDFC, Mr. A will become assessee in default. Assessee in default. And action will be taken against Mr. A. Fine. So now you please read this paragraph by yourself. You will have some more clarity. Let us go to the next question. There is a threshold of 7 lakh rupees for remittance under LRS for TCS to become applicable, while there is another threshold of 7 lakh for the purchase of overseas tour program package where reduced rate of 5% is applicable. Whether these two are separate. Listen here. See, in this section there are two types of payments that are covered. Correct? One is liberalized remittance scheme through authorized dealer, and one is overseas tour program package. Here also you are seeing 7 lakhs. Here also you are seeing 7 lakhs. Now, are these both limits same or separate? Answer is they are separate. Okay. Overseas tour program package is totally different type of payment. That is why the limit of 5 lakh rupees, reduced limit, is different. You have to see both limits separately, both transactions separately. Next question karna. A resident individual spent 3 lakh for the purchase of overseas tour program package from a foreign tour operator and remits the money which is classified under LRS. There is no other remittance under LRS or purchase of overseas tour program package during the financial year. Whether TCS is applicable. Okay, confusing question karna. What is given? Mr. A is making a 3 lakh rupee payment. This 3 lakh rupee payment is both overseas tour program package as well as LRS. It is covered under both provisions. Same payment is covered under both provisions. So which provision will apply? Answer is overseas tour program package only will apply, because it is a specific type of payment. Hence, on this 3 lakh rupees, 5% TCS has to be collected. Okay, wow. Next, there are different rates for remittance under LRS for medical treatment, education purpose. What is the scope of remittance for medical treatment or education purpose? Sir, in this section, we have learnt medical treatment, education purpose. What is this medical treatment and what is the education purpose? What are all the different type of payments that are covered? Let us see. See Ganna. Medical treatment means, number 1, remittance for purchase of tickets for the person to be treated medically and his attendant. So the patient plus one attendant, they are tickets. Okay. Next, medical expense and then other day-to-day expenses. So 3 expenses are covered: tickets, medical expense, day-to-day expense. Next, sir, what is this education? Education also includes purchase of tickets. Now, here is the attendant covered? Answer is no. For education, only the student's ticket price is covered. Then, tuition and other fees to be paid to the educational institution. And thirdly, day-to-day expenses of the student. So for education also 3 type of expenses are covered Kanna. Number 1, purchase of tickets. Number 2, tuition fees and other fees given to the college or educational institution. Number 3, day-to-day expenses. Last question. Whether purchase of international travel ticket or hotel accommodation on standalone basis is purchase of overseas tour program package. So now what they are telling, there is a person who has taken travel ticket separately, hotel booking separately. Now the person has done separately. So is this called overseas tour program package? Answer is no. Overseas tour program package means what? The name itself tells tour package. So it means be a mixture or a club of different services. So they have told that overseas tour program package means at least two of the following should be there. What? Number 1, international travel ticket. Number 2, hotel accommodation, boarding, lodging. And number 3, any other expenditure of similar nature. So in this 3, any 2 should compulsorily be there. Only then it will be called as OTPP. If you are making travel ticket separately and hotel accommodation separately, then that will not be called overseas tour program package and TCS will not be applicable. Okay. So TDS chapter, that's all Kanna. Now let us come to the last chapter, that is provisions for filing return of income. In provision for filing return of income, what are we going to learn? We are going to learn amendment in Rule 114B. In Rule 114B, we have learned certain cases where there is where it is mandatory to quote PAN number. Okay, so where it is mandatory to quote PAN number, there is a relaxation given by the Income Tax Act. Relaxation is given under second proviso to Rule 114B. So we have seen many cases, no Kanna, in return of income chapter. See here, all returns to income tax authorities, sale purchase of motor vehicle other than two-wheeler, opening bank account, making application to bank or any company institution. So all these payments are there, no? Here quoting the PAN number is compulsory. But there is a relaxation. What is the relaxation? The relaxation is that you need not quote your PAN number if you are submitting your details in Form 60. If you are submitting your detail in Form 60, then the assessee need not quote PAN number. However, this relaxation of Form 60 is there, no? That is not applicable to company or firm. So company or firm should compulsorily quote their PAN number. For them, there is no relaxation at all. Other than company or firm can give Form 60. If they are giving Form 60, they need not quote their PAN number. Now let us talk about foreign company. For foreign company alone, one benefit is given. What is the benefit? If the foreign company is opening a bank account or a deposit account with the IFSC bank unit, IFSC banking unit. In our income tax syllabus only, we had discussed about IFSC, International Financial Service Center, which is nothing but Gift City, which is there in Gujarat, correct? So in Gift City, the government wants to promote more and more foreign companies to come to India and open their accounts in the IFSC banking unit. So for them, they are giving the relief. What is the relief? If at all there is a foreign company who is not having any income that is chargeable to tax in India and who is not having a PAN number. So 3 conditions: foreign company, not having any taxable income, not having a PAN. So for such foreign company alone, for the below mentioned transaction, they need not quote their PAN number. What are the transaction? Opening a bank account, okay, and then making a deposit which is more than 50,000 or aggregate more than 5 lakh rupees with any banking company, post office, Nidhi company or NBFC. Okay, so this is more theory. You can yourself go through. It is very, very simple. You will be able to understand. Next, so amendment in Rule 114BA and Rule 114BB. This amendment, these 3 changes we had already discussed when we were discussing the statutory update for November 2023 examination, correct? It is included here also in the 3 points. Cash deposit or deposits aggregating to 20 lakhs or more in a financial year, cash withdrawal or withdrawals aggregating to 20 lakhs or more in a financial year, opening of a current account or CC account by a person. So for these 3 transactions also, getting a PAN number is compulsory, quoting a PAN number is also compulsory. If you are having my latest book, it will be there in the material itself. If you are not having my latest book, then these provisions will be there in the statutory update at the end. Okay va? November 2023 statutory update. So this we have already studied Kanna. Now what is new in this? The new thing is that now this provision, no, these three provisions that we studied, that is not applicable as usual to a foreign company who does not have any income chargeable to tax in India. Transaction is entered with the IFSC banking unit. Okay, so these three transactions are there, no? Now that is a relief also given to foreign companies. That relief is also given to a foreign company who is not having any income chargeable to tax in India and is entering a transaction with the IFSC banking unit. Fine. So for them, quoting PAN is not necessary, getting PAN is also not necessary. So I hope you are clear with these provisions. Finally, that's all Karna. With this, now you are full and final updated with all the provisions of the direct tax law. There were so many updates which we have covered in the series of all these lectures. So from now onwards, with these updated provisions, you can start revising. Revision lectures also, as soon as possible, I am trying to upload on my YouTube channel, trying to record and upload. And share this video, share this series with your friends so that they can also be updated. And I wish you all the best of luck, Kanna. There are only 2 months left for your preparation, I know. Given your heart and soul for your preparation, and obviously you will be able to come out with flying colors. So see you in the next video, dear. Till then, take care. Bye bye.